When we talked, I believe you said you have like 30 or 35 limited partner buildings. Where's that going for you? Are those long-term holds? Are there add value you guys be selling? What's the limited partnership side of your business look like?
Yeah, I mean, so obviously with several dozen of those, they're varied. In general, I'm looking excluding developments, because typically a development is build, sign the tenants, sell it. That's typically the process of a developer. But what I prefer to do is buy an existing property, preferably multifamily. If it's not multifamily, it's more of a commercial building, like an industrial building that they have a long-term lease with a solid credit tenant. It doesn't have to be Amazon in there to do very well. You can have a solid credit tenant. I want the long-term hold. I want those cash flows over time. I like if we're doing a little bit of a value add, because oftentimes after the value add project is complete, after, let's just say, 3 or 4 years after your investment, you've bought down some debt, you've done the value add, and so the valuation of the property has gone higher, which means you can refinance and pull out some equity, which means you're going to pay out your investors. Our risk is going to be reduced. Now, we've probably been earning a little bit of monthly cash flow those 3 or 4 years. So we've been reducing our risk because we've been getting some of our initial capital out. Typically on a refi, you guys can refute this, but you might get another 20% of your original investment back, conservatively, maybe 20, 25%. And you've been cash flowing for a while. So maybe at that point, you got 30, 35% of your money out of that project, yet you still own the same percentage. Now that you're not spending money on the value add component, you potentially, and you're able to get higher rents. So now maybe your distribution goes up. So you were getting, let's call it a 7% annual return. And now maybe you're getting a 10% annual return. So after 4 years, you'd already gotten 30% out. The next year, 40, the next year, 56. So you keep reducing your risk because you keep getting your capital out. But the value of this property has been increasing. You're paying down your debt. So you in theory, you've got a decent amount of accrued equity in there, even though you've gotten out a decent chunk of your equity. So that's the type of stuff that I like to do. And I don't really want to sell. Lately, given the environment we've been in prior to the interest raises, one of the groups that I invest with has sold, let's call it 3 out of the maybe 15, 16, 17 properties that I have with them. And they were just insanely high valuations. So the great part about that is your $1 turns into $3 that you originally invested, let alone the cash flow and the monthly distributions you've been enjoying, potentially the refinance that you enjoyed. Now your $1 is $3. The number one hope is that they find a 1031 exchange, right? So you don't have any tax implications. You can transfer your money into a new investment. And even if your percentage return is less, you might still be earning, in theory, a lot more money than you were earning before on the same amount that you originally invested in. So unfortunately, these were not 1031s because, as I mentioned, the environment is a little different given the interest rate hikes. The returns are lower. There's more capital chasing deals. There's institutional capital chasing deals. They're willing to take much lower returns because they've got hundreds of millions, if not billions of dollars they're trying to park into these investments so they can do what? Earn their fees, right? And generate a decent return for their investors. So it's been more challenging to find new opportunities. I've had to, like I said, take on a little more risk through the development side. And I can share kind of what opportunities and where I think are good if you're looking at the development side of things. But these existing assets, they are getting tougher to find. But I think at the end of the day, if you can be patient, stick with it. I like to invest for the long term. I'm not saying that flipping is not a good strategy. I just don't know as much about it. So that's not a strategy that I pursue because I don't know about it as much. It's about finding what your comfort level is, what your risk tolerance level is, trying to stick with that. One of the reasons why I've gotten into developments and maybe early stage tech investments is because my risk tolerance has grown. I've built this base of, I don't want to use the word wealth, but of assets, right? I've built a base of assets that I think are generating healthy passive income, and I'm more comfortable, right? I don't feel like that broke kid I did when I was in my 20s. I'm still kind of living well below my means because I want to continue to invest and save and leave a legacy for my children. But, it's about kind of finding that risk tolerance and that ideal asset class for you and being consistent and sticking with it.
Yep. So I want to rewind this for a second for our listeners. So whether you're investing as a limited partner or you're buying your own 2-unit, a couple things to pull out there that Bill said. So going back to, let's say you start with a 7% return. You put $50,000 into this thing, whether it's your again, doesn't matter, limited partner 2-unit. But if you're getting a 7% return, that's $3,500 that you're making on your 50. A couple of years go by, you've done a value add, whatever, the markets push you from behind. All of a sudden you're able to collect, half that money back, right? You have a refi, you have some sort of event where now you get 25 grand back in your pocket. You're still, in theory, making roughly around that same 3,500, but now it's on 25 grand. So now you're making whatever that is, 12, 13, 14%. And you have that 25 grand back in your pocket, minus your gains, to go invest into the next thing. Just on a small scale, like to try. And then this whole time, the debt is being paid down. In theory, you're in, real estate tends to go up over time, right? Over the long haul. Doesn't mean it's going to happen in a 3-year period, 5-year period, whatever that is. So that's like the power he's talking about of your 7% becomes 12 pretty quickly, right? And then at some point you have no skin in the game if you want. If you go down that route and you refi and you pull everything out, you now have this asset, the 50K has all been returned back to you, and you go and you rinse and repeat. And everyone's all crazy about, you hear Burr, from Bigger Pockets and doing and accelerating this and doing it all in 9 months or 6 months. And that's great if you can do it, but there's nothing wrong with doing it over a 2-year, 3-year, 4-year, 5-year period, right? Like there's still a ton of value to be had there. And I think that's missed. I think people can't get their money back in 6 months. They get all frustrated and they say, F it, real estate stinks. I can't find any deals.